Good morning, everyone. Welcome to today's tax seminar. Before we jump in, I want to just kind of briefly discuss the goal and what I want to achieve from this seminar. First of all, I want to give everyone that you should have some good understanding of U.S. income tax and primarily self-employment tax for business owners. I'm also going to be discussing which entity is right for you from a tax standpoint if you're in the verge of deciding in between LLC as corporation or even a partnership. So I'm going to be discussing every types of business entities and their tax consequences. I'm also going to touch on how to maximize deductions on auto expenses, whether to depreciate or any of that information. And the last part, we're going to finish off with debt and loan situations here and how that affects your business from a cash standpoint as well as from the tax standpoint. Okay, so here's today's agenda. First, we're going to talk about U.S. income tax and self-employment tax. Next, we're going to discuss the business entity types. And I'm going to drill down on S corporations. It's a very popular topic. And next, we're going to talk about auto deductions and loans and end up with a Q&A. If you haven't met me yet, my name is Tae. I'm a CPA, registered and licensed in California State. I have over 10 years of experience working with CPAs and investors in real estate industries and general contractors, healthcare industries, and nonprofit industries as well. I currently own a CPA firm in Murrieta with a team of 4 people, including myself. And our firm is called Tae H and Associates CPAs, PC. Okay, so let's dive into our first section here. Just wanted to tell you, when someone says tax, it's not clear-cut. There is a normal income tax, and there is a self-employment tax. Your federal income tax over here, this is your normal income tax for W-2 earners. You just get a clean tax that you pay. You run up the tax bracket based on your household income, and you pay tax on it. So it's clean and simple. On the other hand, you have a self-employment tax. Self-employment tax, believe it or not, actually, even if you're a W-2 earner, you pay a little bit of self-employment tax. You pay half of it, actually, out of your paycheck. Those are all the Medicare and Social Security, and all that goes out from your paycheck as well. And your employer pays the other half. Now that you are a self-employed, you're paying all of it. You're paying your portion, and you're also paying the employer's portion. So that rate is approximately 15.3%. So I want to talk about self-employment tax mainly for us business owners. It's approximately 15.3%, and 12.4% goes to the Social Security tax, and it stops at $168,600, and that is a 2025 rate. Okay, so what that means is, let's say your business earned $500,000. You don't pay 12.4% on the $500,000. You pay 12.4% on the $168,000, and whatever is remainder is exempt from Social Security tax. And in addition to that, you pay 2.9% on the Medicare tax on your entire self-employment income. If your household income is more than $250,000 for married folks, $125,000 for married filing separately, or $200,000 for single or head of household, you will be paying more tax, about 0.9%. So if you looked at your tax return, you'll see, oh, where is that coming from? A little additional tax. Usually for folks who's making more than these figures, we'll start to see that. These are the incomes subject to self-employment tax. If you had earned income outside of payroll, so what that means is you received money without getting a W-2. So in a sense, that's a 1099, right? Technically, even if you did not receive a 1099, but you received income more than $600, you are required to report that income into Schedule C as a self-employed income. Some of the examples of the self-employment self-employed income is DoorDash, any Uber deliveries, you got paid with Zelle by doing some work for someone, Venmo, and there's more to that, right? PayPal and all those cash apps. You did some work on the side and got a 1099 form. You're an independent contractor, or you're a sole proprietor who just run your own business out of your personal name, or you're a single member LLC, and there are much more to that. So here's a brief example of someone's tax return. So I've had a client last year. He came in, had this business that was making a lot of money, and so his self-employed income was approximately $557,000, and he was a single member LLC. And here's a taxable income over here, $602,000, and then he'll be running up these tax bracket to calculate the income tax. Okay, so that's the first page of your 1040, your tax return. Okay, we're going to go to second page. The upper section of your second page calculates the tax now over here, and so the first line, that $154,000 is normal income tax, the left side of the table that we saw earlier. And then if your income is a W-2 income, it'll stop there, right? But this client over here, he had to pay additional tax of roughly $38,000 because the income came in as a self-employed business. Okay, so he's having to pay additional $38,000 because it's his business. And that is where a lot of business owners, especially new business owners, are caught off guard. Because you simply thought you would pay a normal income tax on the upper line and be done with it. But you see additional tax there. And also, that self-employment tax is calculated on your business income, $557,000. What I mean by that is if you had any IRA contributions, student loan deductions, any of those adjustments happen here in line 10, adjustments to income, that'll reduce your $557,000. So there was a case where your total taxable income was much lower, but you'll still see this self-employment tax being taxed based on your business income, right over here, based on that $557,000. Okay? So it is crucial that you focus on your business income, regardless of how much of other deductions you have outside of the business, such as retirement contributions, not the business, but the personal retirement contributions, and etc. So now we're going to move on to the different types of business entities. There are sole proprietorships, there are limited liability companies, LLCs. The first one is an LLC owned by single member, one person. Second is LLC multi-member, owned by multiple people or entities. And next is limited partnerships. And the last is corporations. You don't see it as corporation here, and then I'll explain why. Okay, so first is sole proprietorships. Sole proprietorships are unincorporated business owned and operated by one individual, meaning today you decided to run a business under your name, get a DBA, you just use your social security number to get a 1099. That's a good example of sole proprietorships. It has no legal distinction between the owner and the business, and the owner is personally liable for all debts and obligations of the business. On sole proprietors, you must report business income and expenses on their personal tax returns. And there's a Schedule C form within your personal tax return that you file to report all the business income and expenses. Okay? That tax return is due April 15. The income earned on the sole proprietorships is subject to self-employment tax, and you file a Schedule SE, stands for self-employment, to calculate the self-employment tax. I've seen sometimes some sole proprietors hiring employees And so in order to set up payroll accounts, you can obtain an EIN number from IRS under your sole proprietor status and open payroll accounts so you can pay your employees. There are some retirement plan options for sole proprietors also. You can set up a SEP IRA or solo 401k just for yourself. But solo 401k, it requires you to run a payroll. So from the payroll, you withhold the 401k contributions. Sole proprietors can deduct home office expenses if applicable. There's a form called 8829, and this is where your accountant asks you a bunch of questions about what's your home square footage, how much utilities expenses did you spend, and all that, so they can add it to your tax return. Sole proprietors can also deduct auto deductions, and you can take either actual or their mileage on their Form 2106. Sole proprietors get paid from their business by simply taking an owner's draw. And I discuss all this actually specifically for sole proprietors because some people think sole proprietors cannot take deductions. That is not true. It's treated as if it's a normal business, so you deduct all the normal, ordinary, necessary business expenses. So next up, we're going to talk about limited liability companies, single member. And this is by far one of the most popular entity that is being created by LegalZoom, BizFile, and there's so much more online platforms where you can simply go on and create an LLC right away on the spot. This right here, LLC, is one of those popular ones. And I've seen these LLCs being created a lot these days. Limited liability company single member is typically owned by one individual, or it could also be owned by married couples jointly, either 50-50 or whatever percentage they decide, if you are in a community property state. Okay, so California is a community property state. Then if a husband and wife owns the LLC jointly, that LLC is treated as a single member LLC. And by default, your single member LLC is called a disregarded entity. What that means is your single member LLC does not file its own tax return. The single member LLC's income and expenses are filed in your personal tax return combined, just like how you did over here in sole proprietorship in Schedule C, right over here. Okay, and that tax return is also due April 15th. Now, some states might require a separate LLC filing. I have a few clients here that I filed Form 568 for California State, and that's where it triggers that the good old minimum tax that California charges on the LLCs. Okay, there's an LLC tax, at least $800 that you got to pay every year, right? Of course, your single member LLC income is also subject to self-employment tax, and the owners, their personal assets are generally shielded and protected from the LLC's debts and obligations. But I've seen a lot of this happening as well, is there's an improper conduct, which means one of the most common situations that I see is there's a lot of commingling happening in between personal and business funds. Running LLC business out of your personal accounts that you're also paying your mortgage, your personal bills. That is a red flag, unfortunately. And so I'm not an attorney, but from what I've heard, from what my attorneys told me, was that you're losing the whole purpose of creating the LLC if you're commingling funds there in between personal and business. So you want to do that right. Plus all the other things that you got to do that right, that you got to let your attorney take care of that. And another reason why this LLC is very popular is this LLC is very flexible in a way that it can be converted into an S corporation, or it can also be converted into a C corporation. Okay, so I've got a client who was a general contractor, created an LLC, and he particularly wanted his company to become a C corporation for CSLB and bonds, and they have different policies for the entity types, and it's more in favor of the corporations. And so he was able to convert his LLC into a corporation and get a better deal with the insurance and the bonds and all that for his business. So LLC is convertible. It's one of the popular entity for you to create if you're not sure where to go with. From a tax standpoint, this single member LLC has no difference in between you as a sole proprietor or an LLC. Just because you have an LLC doesn't mean you're saving a lot of tax. There's no difference. You're spending more money, right? The California state franchise tax and all that. Okay, how do LLC owners pay themselves? You can simply take an owner's draw. Okay, you just transfer your amount that you need and take that draw there. Before I discuss the next types of businesses, I want to introduce to you pass-through entities. You've probably heard of this a few times from different places, but I want to kind of give you a diagram here to discuss what this is. Pass-through entities, generally, the entity itself, the company itself, does not pay any tax. Okay? However, the company transfers or the company's owners take on the profit and losses from the business, and the owners pay an income tax that the owners pick up on their company's earnings. All right? So a similar example could be this situation here, where my client had an income. This 557 will be the situation where if you have a pass-through entity income, then that income will be also reported on your personal tax return, such as in this case, and you'll pay tax on it, on whatever applicable taxable income that will be. So keep this in mind. Every time you hear pass-through entities, first thing you will know is, oh, the business doesn't pay tax. I pay the tax as the owner. Okay? If a pass-through entity has multiple owners, then each owner will take their share of the profit and loss and take the tax burden on their personal tax returns. Okay, and so these are the pass-through entities here. It's a little difficult to see, but first you have the sole proprietorship. Obviously, all that income is passed through into your personal. Next up is your partnerships. Now, partnerships are a little tricky. It depends on what type of a partnership it is, but I'm speaking generally. Partnership incomes are passed on to the partners, and each partners pay tax on that. Next is the LLC. Okay, and this includes both single member or multi-member LLCs. And next is your S corporations. Sole proprietorship has one owner. This information is just some additional information. We're going to touch up on this later on. So these are all pass-through taxation. Some of these are subject to self-employment tax liabilities there. Okay, so let's dive in here to the pass-through entities. This one over here particularly is LLCs with multiple members. So this one, you have an LLC with you and your friend. I guess that could be a good example. All right, so this LLC is a pass-through entity. By default, LLC with different people, that's not your spouse, is immediately triggered to be treated as a partnership from a tax standpoint. Okay, so when you have a joint business, all the income and expenses by the multi-member LLC is to be reported on the partnership income tax return over here in the forms 1065. Okay, some states require a separate LLC filing. You've seen that on the LLC and the multi-member LLC, single-member LLC as well. So multi-member LLC is the same situation. To the federal level, you'll file a 1065, and to the state, you'll file the Form 568, and you'll pay the annual tax on that. LLCs with multi-members can be subject to self-employment tax. The reason why I say this can be is because it depends on what type of income the LLC earned. Okay, so one of the most popular income that is not subject to self-employment tax is passive income. Okay, we don't pay self-employment tax on rental income, interest, or dividends. Okay, so a lot of times you team up with someone to pool money and you buy a rental property. you need to first create an LLC, like this one here, as a multi-member, okay? And a rental income generated from this LLC is not subject to self-employment tax because it's a passive income, okay? So unless it's a management company, then that's a different story. The income generated by this LLC passed on to the partners simply pay a normal income tax, ordinary income tax, not a self-employment tax. Personal assets are shielded generally from the LLC's debts and obligations, again subject to the shield being, the veil being pierced. This LLC also can be converted or elected to become a corporation or S corporation. Okay, so you still have that flexibility there. Generally, limited liability companies with multiple people, we call the owners, we call them members, not partners. I don't know why, but they're called members. So these members, they can pay themselves by either taking a guaranteed payment or partner distributions. These are fancy words. Partner distribution really means taking an owner's draw. Okay, guaranteed payment is, let's say you have one partner that works more than the other partner. Okay, so it's not fair, right? That's one of the most common issues with partnerships is situations become unfair for somebody. So what you do is, okay, you know what, Tae, you are doing all the bookkeeping, you're doing all the administrative work. We're gonna compensate you for that work. Okay, so that's a guaranteed payment that you're gonna receive every year. And then outside of that, then we'll give you a distribution. All right, this entity is not subject to income tax. It's a pass-through entity. The partners pay income tax. This one very important part here, with respect to tax returns that's being filed with 1065, partnership tax return. If a business has a loss, okay, you can only take that loss against your investment that you put into the business, right? Which it's pretty common sense, but it happens especially when your business has a lot of loans with huge cash balance with a small income, and the owners decide to take a lot of cash out, a lot of owner's draw. Okay, then what happens is on paper you have a loss, okay, a taxable loss. However, your basis, your investment in the business is zero or almost nothing, because where did that money come from that you took a draw on? It came from a loan, right? So in that situation, you cannot take the loss in your personal tax return, right? So in this example, let's say that $557,000 was a loss. Let's say that was a negative number, okay? Which is a good thing, right? Your business lost money. But there are cases where even though your business lost the money, you cannot deduct that loss in your personal tax return because you don't have enough basis in your business. Okay. Another example that I can share really quick is, let's say you bought some Facebook stocks at $100. Okay. And all of a sudden, something goes wrong with Facebook, and they say, okay, you lost $200. I don't know how that's even possible, but let's say you lost $200. Well, my invested money is only $100. So what I can take a loss on is 100, and it stops there. All right. So that's the concept that applies here to the basis limitations. The second part is limited partnerships. So limited partnerships have more limitations to what the partners can do within the business. This is very common for private equities, real estate investment trusts, or any kind of joint venture type of setup. Not too common, but you do see this a lot in more of an investment world. This is a pass-through entity. It's obviously owned by more than one individual entities. And this partnership income or expenses are reported on 1065 on the partnership tax return. And this also could be subject to self-employment tax if the partnership runs a business that has earned income. Then the partners also can pay a self-employment tax. And this also depends on what the partner does and their nature of contribution to the business. This is all, self-employment tax. Personal assets are generally shielded from debts and obligations. Same scenario there. So partnerships are a little tricky because one partner, hey, I'll give you $20,000 of cash. You put in your sweat equity. So you do a lot of the work. I'll put in $20,000. Documenting all that is a big project. I'll tell you that. So partnerships are not as clean and simple because you need to keep track of how much did you bring in, how much did you take out for each partner. You have to keep track of that, okay? And so that's where the partner's basis gets adjusted. The partners can get paid by taking a guaranteed payment or partner distribution. Some partners also run a payroll, okay, to compensate their partners. A lot of the accounting firms or law firms are pretty typical on we receive a paycheck and a K1 on top of that, okay? So K1 over here, that's the next thing here that you see. Every time you hear pass-through entity, except for sole proprietorships and single member LLCs, you will see a K1, okay? And so what that K1 is K1, it's connecting in between company and the owners. And so this profit and loss over here, that is going to be reported on your K1. And you include the income from your K1 to your personal tax return. Okay, so it's very similar concept to a 1099 that a business sends to you, but it's a different name. It's called K1. Next topic here is C corporations. So when someone says, I have a corporation, okay, a lot of the times people say, is it an S corporation or is it a C corporation? But the right answer really is this one over here. The right answer is C corporation. C, we just put a C because people get confused with the S corporation. So this is a corporate entity, okay, that you created. It's a completely separate entity, which means you do not get this profit and loss passed down to the owners. It is not a pass-through entity. This company over here does everything on its own level, take care of its own taxes, take care of its own income, and whatever has any net earnings or profits, it'll issue a dividend, okay, to the shareholders. So we receive dividends sometimes, right, on our investments. Those are corporations there. And the corporations are owned by shareholders, okay, depending on the number of stocks that you own. The corporation's income and expenses are reported in a tax return form 1120. Corporations pay a flat 21% federal tax, okay? California state corporate tax was approximately 8%. It's also flat. And there's no brackets to worry about. This has become very popular after the Tax Cuts and Jobs Act back in 2018, where President Trump made it 21% flat, where if you were an S corporation with a high income, you'll be passing a high income into the personal tax return, where your tax brackets can go up all the way up to 36%, right? So this has become very popular and also can be abused, right? This loophole here. Corporate income is not subject to self-employment tax, okay? But they just pay a flat corporate tax. The shareholders' assets are they're shielded, assuming the corporate does its own proper job of keeping everything separate and proper. The limitations of corporations. These two things, a lot of the small business owners are not aware. And so if you're thinking about opening a corporation, be very careful to check on these two areas here, okay? Accountants, lawyers, healthcare people, doctors, nurse practitioners, etc. There's a list of professions that will fall under some of these items here. The first is accumulated earnings tax. Remember I said earlier about, well, hey, how about my corporation makes $2 million, okay? I'll pay a 21% flat tax, keep it in the corporation, save a lot of tax that way. Isn't that awesome? Well, not quite, okay? Because corporations are subject to double taxation when the shareholders receive a dividend, okay? That dividend is taxable to the personal tax return. So what a lot of the people did earlier to cheat the system was they would not issue a dividend, okay? They will park all that earnings and income in the corporation so that they will only pay the 21% tax, and in their personal tax return, they will have 0 on their dividend, right? So in order to prevent that from happening, IRS set a rule for accumulated earnings tax that if there is an excessive amount of earnings that a corporation is holding on to it, okay, there's going to be additional 20% penalty on that, okay? So you still, at this point, you still need to take on dividend, all right? So you can't really get away from it. But it is IRS's job to, they have a burden of proof. Basically, we have an attorney in the house, so I need to use some legal words here. They have the burden of proof to say how much is the excessive amount of earnings that your business is holding on to, right? So it depends on your business, right? If your business needs $500,000 in to cover operating expense, then I say that's a reasonable amount to keep in your account, right? So it depends on the size of your business to decide what is the excessively accumulated earnings or not. The second limitation for corporations is personal holding company tax. Okay, this is where I mentioned about the accountants and the lawyers and doctors, where we provide personal service contracts where our income comes in majority of the time from personal services that we provide. Okay, I provide income tax returns to individuals, consultations, and so our income is subject to the personal holding company tax if we do not distribute this income to ourselves as in the form of a dividend. Okay, so it's very hard to get out of this situation, all right, without doing a double tax situation. So for a lot of the doctors and lawyers, accountants, the best setup is S corporations so that we don't pay any double tax there. So let's discuss S corporation, our very favorite S corporation. Okay, so S corporation, to begin with, this one here is not a legal entity. Okay, remember that earlier when I listed out a list of entities, S corporation was not on there because this S corporation is a tax treatment. It's a tax status that you obtain from IRS. It's only in between in the tax world, so to say. Okay, if you look at your business at its own, you know, if it could be LLC or corporation, but this is only a tax topic here. If you have a LLC or a C corporation, okay, then you can file a Form 2553 with IRS and receive an S corp status. Okay, so in order to do that properly, if you're thinking about doing it by yourself, what you need to do is file 2553 timely, obviously, so that your due date is within 75 days, 75 calendar days from when you want your business to become an S corporation. So let's say you want your business to become S corp on January 1st, all right? Then you have 75 days after that. Within that 75 days, you need to send in this 2553. However, you can always go back 3 years by electing a late filing request. It's called Revenue Proclamation 2013-30. So there's a little explanation you write, and you can request a late election of the S corp status. So it is not the end of the world if you're late, but generally you need to file it on time. When you file your 2553, you do not sign this form electronically. There is no DocuSign. There is no electronic signature involved here. You need to put your pen and sign it, okay? And when you file this with IRS, I normally like to do it 2 different ways simultaneously. The first way to do is you fax a copy to IRS. The second way I do on top of that is I mail a certified mail with the tracking number on it. Okay, so there's no way out that IRS will argue they never got this form because you sent it out correctly. So you have that. The second part is within about 30 to 60 days, or it could be 75 days, IRS will respond to your 2553 filing. Okay, they will always respond. If you did not receive a response, it's somewhere sitting in the mailbox, or you lost it. Okay, because they always send a response to you. The response will say they approved your S Corp status or it is rejected for whatever reason. Okay, so when you receive that approval letter, it is very important for you to keep that copy. That is not a trash. You need to keep that as a permanent legal document along with your tax documentation. With that out of the way, so IRS grants the S corporation status on the entity. So now your entity became S corporation. So it reports its taxable income and expenses into an S corporation income tax return. C corporations file in a tax form 1120. So S corporations file in 1120S. And also, one thing that I didn't mention here is S corporations, regardless of your entity being an LLC or a corporation, you're going to be filing a 100S with California state. I don't know about the other states. But with California, you're filing 100S. You're not filing 568 for LLCs or different forms there. So just to reiterate, your entity can be, Tae H Business LLC. That's the business name, but you're still filing in 1120S because it's an S corporation from a tax standpoint, if it's an LLC. If it's a corporation, you still do the same. Tae H Company Inc. Corporation, that's the name, but still you're filing 1120S as an S corporation. So S corporation is a very good setup, all right? Now the reason for that is S corp owners receive a waiver on their self-employment income tax, okay? So if you were an S corporation owner, you would not see this line here, 23. That will be completely zero. And you will only pay an income tax, okay? And any other, investment income tax or whatnot, the taxes that the high earners cross into. So S corporations are exempt from self-employment income tax. And also, S corporation owners, they don't have to worry about double taxation, right? All of their income is passed through immediately to your personal income tax return, so you pay tax on it. So it's kind of a win-win situation here, okay? I'm not paying a self-employment tax, and I'm also free from double taxation. Well, hooray, and that's great. Now, there are some requirements to maintain your S corporation. Okay, first, the S corp owners can only be individuals, trusts, or certain estates. They can be owners, okay? If you have a partnership, if you have a corporation or LLC or any of that, they cannot own the S corporation, okay? So we're thinking, keep it simple, a mindset here, all right? S corporations cannot have more than 100 owners or shareholders. S corporation cannot have more than one class of stock. Some companies have different classes of stocks to treat the shareholders differently, but you cannot do that in the S corporations. And this last part here is very important, is the shareholders of S corporation, you must receive a reasonable compensation via paycheck by running a payroll, which is subject to payroll tax, and the remaining earnings can be taken out as an owner's draw. Okay? So earlier I said, hey, S corporations are not subject to self-employment tax. Well, hooray, and that's great, isn't it? But they still want you to pay a little bit of Medicare and Social Security tax over here by running a payroll, okay? So what you do is you set a reasonable amount. What you think is, based on your knowledge, is reasonable for your industry, for your years of experience, okay? What I particularly do for my clients with reasonable compensation is we do a little study. We scope out the market. But we all here, as a business owner, we wear many hats, okay? If you're a general contractor, you're not just doing general contracting 100% of your time. You're working on billing. If you have people to deal with, you're doing HR stuff. If you're doing your own books, you're an accountant. You wear an accounting hat, okay? So you got to figure out, what I do is I interview my client. How many hours do you spend on HR? How many hours do you spend on billing your clients? How many hours do you spend on actual general contracting work? And how good are you on each of these areas? So that I can pick the upper side of the wage or the lower side of the wage, okay? So depending on that, we piecemeal them and put it together, and the result of that generally gives you a very low but acceptable and reasonable payroll that the S corporation owners can pay themselves through a payroll, right? In that way, most of your income will be coming in as an owner's draw over here, and your payroll tax will be minimal, okay? One more thing that I want to discuss about payroll taxes here. Saving money is not always a good idea either, right? Because some of that payroll tax goes towards your Social Security account, right? Some of those Medicare goes toward your benefits as well. So you need to be careful about that. Not, always minimizing this is not always a good idea. But the goal is to find the sweet spot, the number that works for both you without getting into trouble. Laid out some pros and cons of S corporations. Obviously, pros, it's not subject to self-employment tax. It's a simple structure. If your S corporation has a loss, then it can be used against your personal tax return. If you have a $200,000 W-2 income, but you have a $50,000 loss from your S corp, you can reduce your overall taxable income against it, assuming that you have enough basis in it. You're pretty flexible in taking owner's draw, okay? So if you have a C corporation and you're not good at keeping things separate, and you just transfer money into your personal account regularly, and that's your routine, you should never ever be a C corporation owner. Because every time you do a transfer, that is a dividend, okay? And you can argue, Tae, no, that's a shareholder loan. I'm just loaning myself money. No way. It is not a loan, unfortunately, according to IRS, okay? And this has been happening for many, many years in the past. There's always shareholder loans happening here. But from audit case that I looked at, IRS argued, and they went ahead and asked for a loan agreement. Do you have a loan agreement in between you and your business? Well, no, I don't. Well, or also someone created kind of like a line of credit type of loan agreement. Hey, you could move money back and forth up to X amount of money. Is it reasonable? Are you charging interest? Is a loan term proper? So you can't just set a loan agreement that is only to your favor. It has to be reasonable loan agreement. So my answer to you on the shareholder loan, unfortunately, is no. The S corp benefit is that if you're a person that likes to take owner's draw regularly, you need to be an S corporation. I guess in different entities too, but just not a corporation. Okay. The downsides of S corporation is obviously I mentioned shareholders are required to receive a paycheck. Okay. So now, there's a lot of questions being asked around, hey, when is a good time to change your entity into an S corporation? And there is a number being thrown around, $50,000 or whatever, right? I beg to differ, because it really depends on your reasonable compensation amount, okay? If your reasonable compensation amount is $50,000, and your business earned $50,000, you're sweeping the whole thing to run a payroll and paying a payroll tax. you wasted your time and money because the result is the same. You still pay the payroll tax, okay? If your reasonable compensation is $50,000 and your business earned $200,000, then you have a difference of $150 that you will save by not paying the self-employment tax. So then in that setup, I would highly recommend that you switch your entity into an S corporation. Okay? You also need to measure out the costs of running the payroll. Okay? You have to pay the payroll companies, dealing with all the HR and all that stuff. Is that cost worth it? You also have to worry about S corporation filing its own separate tax return, right? If you were a sole proprietor or single member LLC, you had your own tax return only. Now you're having to file a S corp tax return separately. That's going to cost you money, right? Because I'll charge you for the S corp tax return work as well. You have to have a proper bookkeeping, okay? If your books were just on a spreadsheet or on a notepad or on a shoebox somewhere, now that you're an S corporation, if your income is more than $250,000 gross, you're required to report a balance sheet, okay? And personally, I think a lot of business owners underestimate the power of balance sheet. Balance sheet is very important to your business. It tells you what the business owns and what the business owes. And really, if by just looking at a balance sheet, you can tell how the business will do in the future. So it is very important that you keep a good set of balance sheet as well. And so it's going to cost you bookkeeping, payroll, tax return. A lot of the folks don't think about this before creating an S corporation. Okay, so you need to measure out the cost. Is it worth the money and time? Okay, and if it is, then that's the time when you switch into an S corporation. This is the last slide about the S corporation. These are some of the common mistakes that I've seen on S corp owners. This part is this one was really good. I saw someone create an S corporation on their rental property. Earlier, I said rental income is not subject to self-employment tax. So one of the biggest benefit of S corporation is it's not subject to self-employment tax. But if you have a rental property that you're receiving money and you're not paying any self-employment tax, why did you spend all that money to make it a S corporation, right? You wasted your money and time. The second common mistake that I see a lot is your assets are not separated clearly, okay? Commingling business and personal assets. Now, that one part I want to discuss real quick. Sometimes us as an S corporation owner, we use our home office. Sometimes we use our spouse cars, okay? And that happens. And that is okay to do that, but you need to document it, right? And one of the main way to document it properly is by reimbursing yourself. And you can't just do a Venmo me, or you have to document how much did I spend and how much of that is business portion. And so that specific dollar figure, you write a check to yourself as a reimbursement. Okay. Poor accounting records. I've seen a lot of S corp owners, and don't get me wrong here. I'm not trying to point a spotlight on anybody. We're all business owners. We got a job to do here. So it's just real a situation that I've seen here, and there's not a lot of good proper record keeping that I see. And the next one here is not keeping track of the shareholder's cost basis. Okay, in 7203, that's a shareholder, it's a tax form in your S corp tax return that keeps track of your basis. Okay, earlier I mentioned that if your basis is 0, then you cannot take a loss, right? Well, I've seen some tax returns with no 7203 in it to begin with, and they lost a lot of money. Oh my goodness, unfortunately. None of that loss is deductible on your personal tax return, okay? Not running any payrolls, not paying yourself a reasonable compensation. That is another red flag as well, okay? And another IRS court case that I saw, this was a CPA firm got audited, so that kind of makes me a little nervous. I mean, I get a paycheck, so I'm not nervous about that. But so what IRS did in this particular case was
they hired I think Robert Half or someone. They hired some recruiting company, and they picked the highest salary possible in the CPA firm's region, and they imposed a payroll tax to pay by that CPA. Okay, to their benefit, obviously, right? So if you as a business owner, like what I do, run a reasonable compensation test that is documented and approved, then you will definitely win that case. Okay, so that is another situation that I see there. I want to just briefly talk about the hierarchy in S corporation owners to pay yourself. Okay, the priority number one is you need to first pay yourself using this reasonable compensation. All right, and then if you have any other remaining earnings and profits, that's the money you take in as an owner's draw. All right, I mentioned earlier about reimbursements. Okay, if you were a sole proprietor or single member LLCs, you use the form 8829 or 2106 within your personal tax return, okay, to just simply, hey, my CPA, this is my mileage, these are my square footage, get it done, right? Now, if you're an S corporation, not so simple, okay? You have to have an accountable action plan, okay? And this accountable plan is an agreement in between you as an S corporation owner and your business. And the written language will say, S corporation will reimburse you for any ordinary and necessary business expenses that the shareholder spends out of pocket, all right? Keep it at that. Both parties signed and executed. Good. Okay. Now, every time you spend money, every time you drive your personal car, every time you have expenses, you submit a reimbursement request. Okay. Just like how your employees will bring in some receipts and say, "Hey, Tae, I bought some of these for your business here. Per your request. All right. Here's an expense reimbursement form." And give me my, reimburse me, okay? So reimbursement needs to have a good supporting documentation, all right? So I have a worksheet, and anybody can create it to Excel or whatnot, that calculates, all right, your home square footage. It's very similar to what you do on the 8829, but you got your square footage and all that, mortgage, interest, and property tax, and insurance, and utilities. If you're doing if you're using personal car for business, then you document your miles, okay, and get your mileage reimbursed. If you end up spending some money out of pocket while you're traveling, you can get that reimbursed as well. This reimbursement should happen in timely manner, okay? So they want you to treat yourself like a regular employee. So when an employee comes over to you and say, "Tae, can you please reimburse me?" I'm not gonna sit for a year, right? I'm gonna reimburse right away. So you need to do that in timely as well. General rule is no more than 120 days. So that's about approximately a quarter, okay? Well, this is another good perk here for accountable action plan for specifically S Corp owners, okay? You're getting reimbursed for using your personal car in your personal home. A reimbursement is not a taxable income to you, all right? You used your resources, so you got money repaid back to you, okay? So now what happened over here is you submitted a reimbursement request, and you got money on your mileage, on your home office, from the S corporation to yourself. And so earlier I said there's a hierarchy in paying yourself by running a paycheck and taking an owner's draw. Well, if you run a paycheck, that's taxable income, okay, and you pay self-employment tax. If you take owner's draw, that frees up taxable income, right? So you pay tax on that as well, on the taxable income. If you receive a reimbursement from your business, that is not a taxable income to you, okay? So now you've killed two birds with one stone. You created a deduction for your business by taking mileage and home office expenses, and you got money in your pocket from the business. That is not a taxable income to you. This is the last, no, we're almost towards the end, but I want to discuss about our favorite auto deductions. I'm not going to talk anything about social medias, okay? because there's a lot out there about auto deductions. Who over here bought a G-Wagon? Can I see a show of hands? Nobody does, right? So why there's so many accountant advice about, vehicles more than 6,000 pounds, a luxury vehicle? I don't understand that. Let's be real here. So with respect to auto deductions, you have two approaches, all right? You have a mileage method and you have an actual expense method. Before jumping into this, the deductible portion, all right, on the mileage or the actual expense is only to your business use of your vehicle, okay? So if you use your car 50% of the time, then we're bringing down a notch to 50% and then calculating mileage or actual method, all right? If you use your vehicle 100% of the time, or maybe I should say 99.9% of the time, then that's your scale here, and we're calculating deductions within that business use percentage. First is your mileage method. You have to track your miles, okay? Nowadays, you got an app, Mile IQ is an app that I used to use, is very good, and I think QuickBooks also has its own mile tracking apps. There are a lot of different apps. So you need to track your miles and document it, and you're going to deduct your mileage based on the IRS mileage rate. Currently, it's at 70 cents a mile. That's a very high rate. So just think about that every time you drive your vehicle, every mile you're deducting 70 cents against your taxable income, okay? Even if you're not spending money on that car. If you're using a mileage method, you cannot take a depreciation expense, okay? So the 70 cents a mile is already taking account for depreciation of the vehicle. So you cannot take a depreciation expense on your personal car, on your vehicle. All of the auto expenses, they must be paid by the personal money, okay? Your gas, insurance, car, repairs, and all that stuff, okay? Now this one is a little tricky, because we're all business owners. We put our business card up when we pay for oil change. So if you do that, then later when you do your mileage reimbursement, you have to reduce the reimbursement portion by the money paid by the business account so that you're not double counting the deduction there. The mileage method, it works if you drive a lot of miles and your vehicle is not expensive. Now the second option here is actual expense method, all right? You still need to track your miles in this case as well. The reason for that is IRS will determine the percentage use of your vehicle based on the mileage driven in between business and personal. Okay, you drove 20,000 miles this year and 15,000 was business and 5 was personal, then you're taking that percentage. All right, and any of the actual money spent on the car, you have to reduce it by that person. If it's 75%, then you're only deducting 75% of the auto expenses that you spent. Okay, so here deduct portion of the auto expenses, repairs, gas, insurance, registration, and everything. One of the questions that I got was, Tae, is my toll and fast track auto expense? My answer to you is no, it is not an auto expense. It is your travel expense. Okay, so that's a different expense there. If you're taking actual expense, you can take a depreciation expense, all right? So now then you'll see your vehicle listed on your depreciation schedule on your tax return, okay? Obviously, the maximum depreciation you can take on that car is how much you pay for it, right? You pay 30 grand for it, you're not gonna take a 50,000 depreciation. Actual method works if you do not drive that many miles, but you drive a very, very expensive car like this G-Wagon over here. I want to present to you a little scenario, okay, based on what I laid out here. So the first scenario is business miles driven, 35,000 miles. And so on this example, I'm going to assume that the vehicle is used 100% for the business, okay? So you're driving 35,000 miles. you paid 40 grand for the car. You paid roughly $8,500 on auto expenses, oil change, repairs, insurance, registration, gas. I guess that's reasonable. And the effective tax rate is 22%. So what I mean by that is, if you look at your personal tax return, that tax over there, you calculate it by running up the tax bracket, okay? So when you say, oh, Tae, I'm in the 22% bracket. But if you take that 154, divide that by the taxable income, okay? That's an effective tax rate that quickly tells you, okay, just let's think a little simpler here, and what percentage of my total income is being taxed, right? Because if you look at the bracket, it's different, okay? So I'm using a 22% as an example to show you in this scenario. Okay, so first you have a mileage method. You drove 35,000 miles and you're deducting 70 cents per mile. That's an IRS set rate. So your annual deduction there is $24,500. You didn't spend that much money, but you're deducting it. On a $24,500 deduction, 22% effective tax rate, you saved $5,400 in tax. Oh yeah, so if you're getting reimbursed, if you're an S corporation, okay, and you're getting that reimbursed, so because you have to reimburse yourself, then there's in your bank account you see a payment made to Tae $53.90, and your bookkeeper will record it as a mileage auto expense, right? So now you have an expense, and you got money into your pocket. So plus you have a non-taxable, well, I don't think I should say income, but non-taxable reimbursement of $5,400 in your pocket. If you multiply the $24,500 over 5 years, so in this scenario, I'm using 5 years because generally auto vehicles are depreciated over a 5-year period, okay? But in the mileage method, really that mileage deduction happens as long as you drive your car for your business. Okay, it could be 10 years, or if you drive a Camry or any of that, that lasts as long as you can. And on top of that, the 70 cents a mile IRS rate, that is 2025. And we've never seen that rate go down year after another unless something crazy happens. So total deduction over 5 years is $122,000, 500. Total tax savings over 5 years, you're saving roughly $27,000 by taking mileage method. Okay, let's see the actual expense method. So I'm going to do my best to depreciate as much as we can as sooner, right? So we'll take a bonus depreciation. So on the first year that you paid for the car, we took a bonus depreciation. That's $20,400. And then on the years following, you take the remaining from 40 to 20,400, and you divvy that up evenly over the next 4 years, okay? And so that's $4,900 per year. So year 1, you got a big deduction there, and year 2 to 5, you have a pretty small depreciation expense. So bonus depreciation, not always a good idea, in my opinion. And now actual auto expenses spent, the repairs, that's $8,500. That's right over there. And so total deductions you took over 5 years, $8,500 per year plus the depreciation. Deductions you're taking is $82,500. Your tax saving on the first year on the $20,400 plus the $8,500 spent, that's $28,900. On a 22% effective tax rate, you saved $6,300. Total deduction over 5 years is $82,500. So over 5 years, you saved $18,150. All right. So pretty good comparison here. So who's the winner in our example? The winner is the mileage method. Okay. So we see on the first year, you save more by taking a depreciation expense on an actual method, right? Because you got the bonus depreciation. If you're taking a mileage method, it doesn't look as good as it seems on the first year. It doesn't feel good, right? On the spot. but over the years, you're generating more deduction and more tax savings by taking a mileage method. Okay? So this is a scenario based on if you're driving high miles, right? 35,000 miles for a business is considered pretty high. If your vehicle is not as expensive, okay, then your mileage method is the better choice. All right? Let's look at our second scenario here. In this scenario, you're driving only 8,000 miles per year. Your car is worth $85,000. And I'm going to use our popular example, SUV over 6,000 pounds, okay? And you're spending the same amount of money every year on maintenance, $8,500, and the same effective tax rate. Let's run through this. You drive 8,000 miles at 70 cents a mile. That's $5,600 deduction per year. At 22% effective tax rate, you save $1,200 by taking a mileage method. And you got that reimbursed. Good thing, extra money in the pocket. Total deduction over 5 years, $5,600 multiplied by 5, $28,000. Okay, so a good exercise that I like to do is I usually take the cost of the vehicle, $85,000, and I divide that over the $5,600 per year. Then it'll show you how many years it'll take you to recoup to start seeing the benefit of taking mileage method. Okay, because if you're using this old approach, the first year you have less deduction. And so, hey, Tae, then by when will I see the tax savings by taking a mileage method? So in this example, 85 divided by 56, right? That's more than 10 years. So you better drive the same car for more than 10 years to really see the benefit of taking mileage method. And so your tax saving over 5 years on a 22% effective tax rate is $6,000. Let's take a look at the actual expense method. So on year one, depreciation expense, we're going to take bonus depreciation plus the $6,000 pound extra accelerated depreciation. You can deduct $63,000 on the first year, right? So this is where you hear Grant Cardone saying, "I bought my Rolls Royce on December 30th, and then I wrote off pretty much all of it," right? That's what this is, because you took a bonus depreciation. Well, Grant Cardone, on the year after, you don't have any more depreciation expense there, sir. So sorry about that, okay? So that's, sometimes you gotta think ahead, right? Year 2 to year 5, then now you see over here, on year 1, your depreciation expense was $63,000. Year 2 to 5, the remainder, you don't have any more left over, so you're only taking $54.50 per year. Auto expenses, you're still deducting that. I guess you'll be spending more than that, but $8,500 a year, same example. Total money spent and total deductions, tax deductions taken over 5 years, $127,500. That's the repairs and maintenance plus all the depreciation spent on it. So on year 1, on the $63,000 depreciation, you saved $15,774 on year 1. Until your car is fully depreciated, you saved $28,050 over 5 years, all right? And so if you look at this scenario over the 5-year period, all right, actual method actually gives you more tax savings, okay? Because you have a high expense where you're driving low mileage, right? So in this scenario, actual method is better. Again, I say looking at a 5-year period, right? Because from year 6, you don't have any more of the depreciation expense anymore. You only have the $8,500 auto repairs expense, right? Then by year 6, we got to think of some other strategy here. Now, this over here is probably what will happen in year 6, okay? In year 6, they're going to say, okay, let's go ahead and get another car so we can start taking another depreciation. And also, let's sell the car. We're going to trade it in, okay? So we're going to get rid of this car and get a new one here. I need to talk about the bonus depreciation here. Bonus depreciation, in the old days, used to be 90%. Okay, and gradually year over year, it's been going down. All right, and currently it's sitting at 60% for this year, for 2025, if you are planning on taking a bonus depreciation. All right, so keep that in mind. Not all of it is deductible anymore. There has been a lot of conversation happening that the bonus depreciation will go away as well. So just to put that out there. The second part here is I want to go back to our discussion on what happens in year 6, okay? So you want to get rid of your car, trade it in for a new one. Okay, that's awesome, all right? What happens when you trade it or when you sell your car or when you get rid of it? So there are 2 events that happens. The first is, hey, honey, we need that car at home. Can we use it for, personal? Okay, fine. Then it's not a business vehicle anymore. It becomes personal. Or second, you sell your car or trade it in. That triggers a depreciation recapture. All right? And depreciation recapture, as fancy as it sounds, it's not only applicable to vehicles, it's also applicable to basically any business properties that you have on your depreciation schedule, okay? So we're talking, desks, furnitures, computers, whatever you got there on your depreciation schedule. If they are disposed or sold, a recapture is triggered. Okay, Tae, then what is a recapture? What recapture does is it adds back all the depreciations taken previously as an income on the year that you sell it or you get rid of it. It's mind-blowing, right? It's one of the most ridiculous tax codes that everyone will see. But I stand by what I say here, okay? So there are 2 different types of properties that are subject to recapture, okay, at the time of disposal or sale. First is your tangible properties. Again, I said machinery, equipment, vehicles are included in there, okay? The second part is your real estate properties, okay? So this is the reason why I tell people to not put your real estate property under your business. If you have a general contracting business, don't put your house, don't put a rental house under your general contracting business. Also, because when you sell it, then you get a recapture, right? So it's not a good thing to see there. So buildings, leasehold improvements. You move into a nice office and you spend, 50 grand on renovating your suite. That's a leasehold improvements that gets depreciated over 15 years, right? So that also gets recaptured. So that's another thing you need to worry about. Generally on recaptures, the reason why it's not been brought up as much, in my opinion, is because when these events happen, when you sell a car or an equipment, or when you move your office to a completely different place, right? Generally what happens is on that same year, you're spending about the same amount of money, okay? So you have a recapture, and then you also have a deduction happening there on the same year. So sometimes it's a wash. It can be a wash, or it kind of offsets each other. Not entirely, but it happens, right? The second reason why I think recapture has not been brought up as much is because there are tax returns, okay, not being done properly, in my humble opinion. And so you got all of a sudden, year 1 I see a car, and year 2 I don't see a car. And there's no date of disposal. There's no sales price. None of that is recorded properly, right? It's just vanished. So there is no recapture to record, right? And so I think those are main reason why recapture has not been brought up as much. But I'm a certified public accountant here, so I need to make sure I tell you the right thing. This recapture will get triggered if you sell or dispose your car, okay? And in the time of an audit, of course, IRS always reviews multi-year and they compare the assets, okay? So they'll always look at that. The real estate properties, the depreciation recapture is that it is taxed at 25% flat, okay? Regardless of your total household income or whatnot, it stops at 25%. So that's why you see a separate list as a Section 1250 properties. you probably saw Robert Kiyosaki saying, "Oh, I borrow money and I get rich with debt," right? And he said, when I borrow the money, I pay zero tax on it. Well, isn't that awesome, right? But did you know when you pay back the money, you cannot write off as well on that, right? Only, unless you pay interest, but you're still paying that out of pocket, right? So you're still paying money for it. So what Robert Kiyosaki is saying is on the real estate deals, okay, you leverage the debt, you purchase a property, you lease up with the tenants, that's generating a high cash flow, and you sell it within 3 to 5 years. That's a good turnover that you did that generated a high profit for your real estate. I know this because I used to work at real estate investment trusts that does this a lot. But he's not talking to real estate investors. He's talking to normal folks like you and I. That is not applicable, okay? So he's giving out, maybe he can say it's a good advice to wrong people, to the wrong audience, okay? But today I want to bring this to you, to the right audience here, all right? I'm going to lay out a situation here for you. So you have a business, okay? You're going to get some loan to help your business pay for things, all right? Here are the terms. You got a 5%, actually, I think the screenshot covered, but the loan I believe that we're getting is $500,000. So you're getting a $500K, let's say SBA loan over 10 years, 5% tax interest rate. You're going to use this loan to pay a payroll for your employee that you're hiring. You're going to use this loan to buy a huge equipment for your business of $350,000, all right? And you're still sitting at a 22% effective tax rate, okay? In this scenario, you're going to see the income gradually going up over the years because if you're bringing in an employee, if you're buying a huge equipment, your income better go up, right? So you're making a good investment there, okay? So let's run through these years here, okay? Year one, you made a $500,000 gross income. Your operating expense, utility, your business expense is $250K. You paid your employee $150,000 salary. You took a $50,000 depreciation on a business equipment, okay? And I just said that last 7 years. I mocked up an amortization schedule for this, and I calculated the interest. So these are the interests that you will be paying on your loan over the years. And obviously interest is deductible. So you're deducting your interest expense, $24,000. So your business's net ordinary income for year one is $26,000, okay, after taking all deductions. Now, what kicks in? You have to pay your loan, right? So you have to pay your principal balance of your loan. On year one, that's about $40,000, okay? Now your cash is short by $40,000 in your bank, okay? You still have an ordinary income you reported on the tax return is $26,000. What is your tax? Your tax is about $6,000 calculated based on the $26,000. Year two, what happens? Income goes up, okay? Your interest goes down. Your net ordinary income is higher now. Your business is thriving, which is a good thing, all right? What does that mean? You pay more tax, right? So now then your tax goes up to $22,000. What also goes up, some of us who know loans well, is over time you pay less interest, you pay more in principals, okay? So now if you're paying principal, your cash is short by that amount, you pay $41,560 in principal balance loan payment, but you're ended up with higher tax bill on the year two. So you're not, at this point, you're paying money, your money's going out left and right and everywhere, okay? Unless your gross revenue is making a lot of money. So you're paying a loan payment, you're paying a higher tax. Nothing's changing here, right? Same loan payment over the next 10 years, but the tax is going up because your interest expense is going down, right? And your business is thriving. And your loan payment is not a deductible expense. And so on and so forth. For year three, okay, 39 grand, year four, 51, year five, and year six. So this is what happens when your business has a loan. And the only way to survive this is your business is really, really successful. That you keep up with this lack of cash flow, or you stay on ahead of the schedule, okay? And you get rid of the loan, or you do something else, right? So normally, when I see a business with a big loan like this, it's very hard to see businesses lasting more than 5 years, unfortunately. And by then, they always ask me this question here: Tae, where did all my money go? Where's all my money, Tae? I didn't pay, I didn't make more money, I didn't make that much money. It's because you have increasing tax over time due to this scenario. Your principal portion of the loan payment is increasing over time, therefore you're taking less deductions. And because of the overall situation, you're paying more tax year over year gradually. Okay? So you're left with less cash for your business. All right? So make sure you consider these items before you go and get a business loan. And personally, I think a loan is really good if it helps your business to jump your gross revenue significantly, okay? And in a shorter period of time, right? It's not good to see a long loan like this, especially if the balance is too high. And at that point, you might need to reconsider, getting a refinance or selling your business or some other options there. Okay, so this, to me, I thought it's important to bring it up today to the business owners because this is a very important topic that I think a lot of people don't talk about. It is not possible to avoid recapture if your business property is listed in your depreciation schedule. Okay, the only way to avoid recapture is to not put it there the first time. All right, so then you're taking either a mileage method by treating your vehicle as a personal vehicle, okay, and submit a mileage expense report and get your mileage reimbursed. Then your vehicle was never on a depreciation schedule. It's never a business vehicle. It's your personal vehicle that you're using to get your mileage reimbursed. So you can do whatever you want to that personal vehicle. It's not going to trigger a recapture. On the other hand, if you're taking an actual method and depreciating your car on the depreciation schedule on your tax return, then you need to report a disposal of your vehicle. That triggers a recapture. So the only way to avoid it is not put it there to begin with. Okay? Another thing that I want to tell you is you cannot switch back and forth year over year. If you choose one method, you have to stand by it. So if you got, a car, then it has to stick to one method that you choose. Do I have a recommendation on better tracking your mileage and what's the best way to track your miles? So personally, I find using an app came in very handy. I'm not sponsored by Mile IQ. I'm just a very happy customer here. And what Mile IQ does is every time you get out of the car, you get a notification on your phone. Somehow magically it knows, okay? And so then it'll say, hey Tae, you just drove from A to B. What was that trip about? And so I swipe to business or personal, okay? And so personally, I find that app very useful and convenient. Another reason why I recommend using an app is because during the audit, if you provide an Excel sheet or a notepad, okay, with dates and mileage on it, that's you creating it, right? However, if you're giving IRS a report from Mile IQ, where your trips are tracked on time by the GPS system, it is a more reliable source, okay? It's more convincing. So personally, I highly recommend using a third-party app that tracks your movement. If you don't want that, you don't have to do that, but that's my recommendation. Mile IQ also allows you to add more vehicles. It gets a little tricky there. Sometimes I take our kids, we go to Orange County with our family van, and I always got to delete that trip because it was never my car to begin with, right? So you just have to, do that. But I do it, maybe once a month. There's a, huge list of trips, and I just, I categorize the trips there. I've seen, a lady with, she has a journal in her car. And so first thing she gets in, odometer, and then arrival, odometer. I've seen her do that. I don't know how long she can do that, given the amount of work that goes into it though, right? So yeah, I highly recommend using an app. Yeah. Yeah, thank you. Very good question. So the question was, first of all, the S corporation owns the vehicle, right? And you're using that vehicle to commute from your home to your office, right? So that's your normal commute. My answer to you on that is not a deductible trip. That is not a deduction. That is your normal commute. If you're an S corporation, generally, who owns the car doesn't really matter. What really matters is how much of the car you use was used for the business. That's what really matters. Okay? So just because you have the car titled under the S Corp name, it means you use your car 100% for the business. I guess for the most part, you will use it for the business 100% of the time. But if you're using it for personal use, then it's not 100% use. So what really matters, the key factor is that car need to be used 100% for the business. Now, there is a way to make your trip a deductible trip, is you declare your home as a main place of business. Okay, so that's where you run all the administrative work. That's where you run the payroll. That's where you do all the accounting work. That's where you take the calls. Then your home is your main place of administrative office. Then every time you leave your administrative office to get to, I guess, second office, that's your business trip. Okay, so you could do it that way to have it deductible. Again, all of this need to be documented, right? So as long as you can prove that, it is deductible. So the question was, there was a landscaper who makes very successful landscaper, who is a sole proprietor, all right, looking to retire in the next 3 to 4 years. Is it worth getting him into an S corporation to save money on tax? And also, can we do that retroactively to go back and save money on what he did in the past? I will say it ultimately the decision is to the owner, right? You have to set up the payroll account. A lot of it will change. You're going to get a different EIN number. You have to think about, licensing with the CSLB and marketing material. All of that will change. Because your legal structure will change as well. Right now, he's running business out of a DBA, if I'm understanding correctly. Well, it depends on the tax saving. If it was me, I would still convert him into an S corporation, and then still save money there, right? Again, a lot of it kind of depends. We saw the example earlier. The example we saw was about that was a particular client that I helped him. We got him an S corporation election, and his tax saving was approximately $30,000 to $40,000. So it's a good chunk of money, right, that you're saving, and so it was worth for him. It was totally worth it, but he had to get a different this and that done, a little bit more administrative things to get caught up, right, and so. If he's willing to go through that, and it's not too extensive, and if the tax saving is, I don't know exactly how much we're talking, but I need to we need to present it to the client, and hey, here's your tax saving, here's the cost, what do you want to do with it, right? But again, if he's retiring, if he's not going to retire in the next couple years, why not do it now, right, and still save money on tax? That's my recommendation. On your question about going retroactively, my recommendation is no. You can risk it. You can still do it. You can go back. Actually, no, sorry. You say he's a sole proprietor. So unfortunately, you cannot do that. If he had an LLC past 3 years and ran business out of it, then we can do a revenue proclamation 2013-30 late election S corp back 3 years, and change into S corp and redo his tax returns. That'll get flagged, okay, by the IRS agent. It'll sit in someone's desk, and the first question that they'll ask is, should we audit this person, right? So he better have a very good documentation and be prepared for an audit. So that's why I say it's a little risky. But he doesn't have an LLC set up, so he cannot do that. He cannot go back and do anything there. The question was that, hey, can I, go to Hawaii and discuss business, right? Corporate retreat, have a board meeting there. Is that a deductible trip expense, right? And so my answer to you, a lot of it is the way IRS looks at it on this particular situation, they only look at the substance and the nature of your trip, okay? And so what I mean by that is it within your reasonable business operation, right? And if I were to say, hey, my family goes out to Hawaii every year, and I'm gonna get my wife, because my wife is vice president of the company, so I'm gonna talk to her about our office rent a few times. It's just realistically, right? How well is your meeting documented, right, with your wife? Is there an agenda? Is there a trip that was pre-approved by the board members in the past? So and IRS knows if you're making up documentation to justify yourself. So to me, I would say it depends. It's not a yes or no question, because for me, there is a CPA conference in Maui in December, right? So if I were to go and attend that conference, it's a business trip. But if I were to make up a trip and make it a business expense, it's very hard to win that case, in my opinion, because the main substance and the purpose of the trip is for your personal gain, but you might as well let me make it a business trip type of situation, right? So if you're in that scenario, most likely they're going to overturn you on that. You will not be able to deduct it. Yes, yeah. If you went out to Hawaii and you ran into your client all of a sudden in Maui, hey, let me buy your lunch. I will say that is a business meal, that you can deduct that meal. But in order for you to do that will be very difficult to write off the entire trip. Now, if you and your wife went out to a coffee shop and discussed business, you can definitely deduct that meal expense. A lot of the tax rules from the old days have kind of overturned in 2018 by the Tax Cuts and Jobs Act. So I haven't seen the additional tax on the real estate sales other than capital gains and the recaptures happening. Recapture on the real estate happens very rarely because not everybody puts real estate properties under the business entity and depreciates it. Yeah, and if you sell your rental property that you own personally, you're not going to have that. Yeah. Good question. So your question is, do I have to have a DBA if I want to run business as a sole proprietorship? My answer is no. You can still represent yourself as a business and conduct business without a DBA. Yeah, there are some local rules that may apply depending on what city and what county you're in, but generally, you could go and earn income based on your personal name. Yeah. So you're taking the actual method, then all the auto expenses that you're paying should be paid by the business account. Okay. Tae, I have a list of cars here in my business that I'm depreciating right now. But man, I'm driving so many miles. I'm missing out here. I want to switch over here, right? How can we do that? My recommendation, you got to time it right, okay? So you need to first expect when you get rid, so you have to report disposal, obviously, right? Because you're going to switch from business to personal ownership. And once it comes out of the depreciation, then you're gonna have a recapture, right? So what's the cost of the vehicle that you currently have here, right? And then will the recapture be offset by the mileage method you're taking that year to help you, right, not get hit with a huge tax bill, all right? So you have to make that kind of assessment. And maybe on the first year, and I have a client that said, hey, you know what? Because they have, I think they have 2 Range Rovers in the business and a few trucks. And those are all expensive vehicles that they were depreciating on. But they drive all across Southern California for their work. So so I told them this, okay, pick a vehicle, okay? What do you expect to make this year, right? If you expect your income to be lower, then maybe you have more room to take a hit, right, on the income. So then pick a vehicle to take a recapture, convert it over to the mileage method, and you get the mileage reimbursed, right? So then my plan with them is that over the next couple years, we're gonna take a few of the vehicles at a time, because if you convert all of it on the first year, it's gonna be a huge recapture that you'll see on your tax return. So that's one method. And the second method is, you could kind of pick and choose depending on how the year goes, what year you expect to become. If you think this year is gonna be very big and very successful, then maybe you wanna pick cheaper car to move over to the personal side. But so you kind of have to see, is it a good timing? Is right now the good timing to do it? What's the cost of me not doing it? What's the benefit, right? And maybe sometimes you take a little bit of tax hit on the first year, but you will see more benefits kicking in on the next few years following. And another good thing here, like I said, is you depreciate your vehicle only up to what you pay for it, but you're taking the mileage method here. I mean, that never stops as long as you're continue to drive, and you could get a new car, you can dispose, sell, you can do whatever you want. That's not gonna trigger a recapture. Yeah. Right, so the question was, can you choose some vehicles to be used in the mileage method and some vehicles to be used in the actual method, right? My answer is yes, but it'll be very hard for you because you have to pay whatever is in the mileage method for the repairs and maintenance out of the personal account, and you have to pay for these business vehicles in the depreciation method out of the business account, right? Because this is actual method over here, right? And so then, sometimes I'm gonna pay car A with the personal credit card, my vehicle B with the business card. It's very hard to separate that, from a real life standpoint. So it's very difficult. So what I would recommend in that situation is you can still pay all of your vehicle expenses out of the business account. And when you get your mileage reimbursed, you'll subtract what you paid on those vehicles from the reimbursement so that you're not double counting the mileage. But it is tricky because you still need, you're not gonna take the 85 spent on this car to offset the reimbursement on that one there, you know what I mean? Yeah. So it's tricky. You have to keep them separate. So in that case, you have to tell your bookkeeper to have auto expense for mileage method and then auto expense for actual method. Then that'll make your job easier, right? Then when you do your reimbursement, you'll just run the report and just take the mileage method auto expense against that reimbursement account. No tax returns required separately on a federal level. California state will require for you to file a Form 568, which is a LLC tax return for the state. Okay, but to answer your question, there is no distinction from a tax standpoint from a sole proprietorship to the single member LLC. Your LLC can own a real estate property for a liability protection. But from a rental standpoint, the rental income and expenses are not going to be treated as a business activity. That's going to be treated as a rental activity in a Schedule E on your tax return, even though you're actively managing it personally. So that shows that's a rental activity, and any type of LLC expenses you pay, you can report that on a Schedule C, which is a business like sole proprietors will file there. Yeah. Well, the question is, Tae, why can't we not put rental real estate in the LLC? Why can't we only not do it in corporation? But my point was that if you have a general contracting business, regardless of it being LLC or corporation, it is not a good idea for your general contracting business to own a rental property. Yeah, that was my point.
But is there a tax reason?
There is also a tax reason, yes, because generally rental properties either break even or they have a loss every year because you're depreciating that property over 27 and a half years. And you have utilities expenses, you have all kinds there. So for the most part, rentals, on the cash standpoint, is generating cash flow, but on the tax return, you're either breaking even or at a loss. So you don't really need a good tax structure to help you save money on tax because you're already not being taxed as much on it. And so if you put your rental on a corporation, then I mean, for the most part, one of the reasons why you put it in a corporation is, maybe you're selling it, you're getting multiple investors, right? Multiple shareholders to pitch in money so you can buy this real estate property. But also, corporations are tricky, right? Because it's subject to double taxation. So what if, you have a lot of rent collected, there's a lot of cash sitting in the corporation, and you have to distribute that to the shareholders, well, there's a dividend income they gotta worry about, right? Because corporations have its own set of rules. They're not subject to self-employment tax, regardless of what type of income it is, and they only pay a flat income tax on their income. So it's better for real estate activities to remain as a LLC or join a partnership so that it remains as a pass-through entity. Because none of the distributions, the earnings are not subject to self-employment income tax. Why would he put a rental property in the S corporation, right? So you're totally right. Any profit your rental property is generating, you could have taken in self-employment tax free to yourself, right, to get paid. But now that you have an S corporation set up, the profits being generated has to be paid to yourself via payroll first, and whatever is remaining can be taken out as an owner's draw. So yeah, it's ended up spending more money there. So the question is, instead of getting a loan to buy that $350,000 equipment, is it more beneficial for me to just lease it instead of getting a loan? Yes, it is definitely beneficial for you to lease it because then you have a lease payment as if you're renting it, right? So you can expense out the entire lease payment that you pay throughout the year. So you won't have the interest or you won't have this principal payment anymore, but you just have a clean lease payment that you get to write off every year, whether $50,000 or whatnot. And at the end of the lease term, then you'll be offered a buyout, right? And so then at that point, you can decide to buy it or not. But my recommendation in this scenario, leasing is definitely a better option. If you are, so the whole conversation about real estate professional was brought up in the past because people with a loss on their rental property, they want to use that to offset their income from a W-2. You have an income over here, it's hard to see, but that says $90,000, okay? So if you have somewhere over here a rental loss of, say, $20,000, well, isn't that a good thing, right? So you want to write that off. However, generally speaking, if you have a loss from a passive activity, such as rental, you can only offset that loss against passive income within the same category of the passive world there. Okay, so if you have a second rental property with the income, you can offset that income with a loss from the first rental property. Okay, that's the passive loss limitation rule. Now, if you are a real estate professional, and so real estate professional doesn't mean you're licensed real estate broker or whatnot. The real estate professional status is given to you if you spend majority of your full-time hour, 40-hour work week in the real estate activity, okay? So if you do that, either by managing your rental properties or actually working in the real estate industry, you are a real estate professional, then you can argue to IRS that, hey, my rental income is not a passive income, it's an earned income, right? So now that passive activity is now converted into an earned activity. And so when you have a loss, you're now allowed to take that loss against your $90,000 earned wage over there. Okay, so now there's a lot of documentation that you need to do to be able to be treated as a real estate professional. You need to log your hours, and you need to log what you did during those hours, and they have to add up to be majority of the time significantly. And the rule is, I think I heard 570 hours for the whole year, or at least more than 20 hours a week, so that majority of your working time is spent on the real estate activity. Right? Great. Yes. Yeah. Sure, running a reasonable compensation test is good, but I also want to contribute into my Social Security account, right? So to that person who gave you that advice that you want to pay yourself at least to the Social Security limit, is first of all, that person probably never ran a reasonable compensation test, so he or she doesn't know exactly what your minimum allowed compensation should be. Okay, it could be more than that. Maybe she thought it was more than that. Okay, so the attorney's salaries are in Southern California. We're not looking low numbers here. So then maybe she's saying at least, right? If the reasonable comp is $200,000, then that's $40,000 over the Social Security wage limit. So if you want to pay lower than that, you need to pay at least the $168,600 to meet that, right? And the second thought that I have about that is, a lot of the times, because I ran a test for a client of mine, and it came out ridiculously low, okay? Because they just don't spend, they've scaled their business, and they're spending like a couple hours a day on their business. And so, okay, you know what? You're spending 2 hours out of the 40-hour work week. We're going to reduce your compensation significantly, right? Because you're not working a full-time job there. But they're concerned about not contributing to their Social Security account, right? So if that is your concern, then you want to make sure you can pick a higher salary. IRS doesn't object to that, right? But but I still recommend running a reasonable compensation test, because if you don't have any documentation on how you calculated your salary, IRS will calculate one for you. Okay, let's say you don't have a documentation, here's a documentation, all right? So it could be higher, right? So I still recommend doing a reasonable compensation test. And if it came out to be 90 grand, but for you and your wife, we want to get ready for our Social Security. We want to make sure it's fully funded. And so we're going to pay ourselves more than that. That's totally fine, right? Then when you approve in your corporate documents, you'll say, this is a reasonable compensation, the result, but we want to pay ourselves more. You're doing them a favor at that point, right? So you could definitely pay more than the reasonable comp. And I've seen that happening too. I just went through second tax season, and I've been doing tax and accounting for CPA firms in Northern and Southern California. Over time, I've seen more and more business owners, new business owners particularly, just lost in navigating through this whole tax world here. And so today I wanted to shine some light on you and give you better understanding on all of this. But really, I always like to end any type of meetings with this one here. Don't let tax consume your day here, okay? Your job as a business owner is to go after the gross revenue for your business. So grow your business and don't waste your time thinking about tax and be burdened by it, right? So continue to keep your focus on the gross revenue and the tax seminars like this you can attend, get more information to help your business thrive here. All right. Thank you everyone for coming today. And yeah, any questions you have my business card there, so feel free to reach out to our office if you like to. Thank you.